Thank you. Appreciate it. Unfortunately, I usually get it a lot more. So thank you for coming today. You'll have to bear with me. I'm not used to speaking with the microphone, so hopefully you can hear me, or if you decide I don't need it, wave it. I just take it off, but this way I can guarantee everyone hears it. My name is James McIngvale. I'm a CPA in DeSoto County. My office is off of Gidwell Road. We've had an office for about 13 years or so. I'm actually a failed realtor, so your job is near and dear to my heart. I was a CPA first. I decided right around 2007, this is easy money. I'm going to go do this. And then who was around in 2008 doing this, or mortgage lending? You know what happened? Lending crashed, market crashed, economy crashed. And I said, man, what were those three initials behind my name again? CPA, I think I'm going to go do that again. But actually, it was an invaluable experience for me because it opened my eyes to a different world of investing. It opened my eyes to a new network of friends and people. And we do a lot of real estate work, whether it's for investors, rehabbers, builders, realtors itself. So I've enjoyed it. That experience. It's funny, you look back, it's miserable to go through, but it was really good for me and what I do now. As Amanda said, I just assume this be some discussion, questions, feel free to ask. Along those lines, help me remember, we have 20 or so people online who may or may not be able to hear the question you asked. So please say, hey, repeat it. If I don't repeat it, say, bro, what was the question again? But I've been trying to remember this year. It'll be the first year I've ever remembered to do so. But other than that, I will say also that I'm curious. I recognize a few faces, Amy and Jamie, of course. But how many of you have attended this before, out of curiosity? Okay, so maybe even 7 or 8. Okay, good. The reason I ask that is, frankly, there haven't been many changes to the tax rules in the last, really, 2 or 3 years. There were major changes for 2020 from COVID regarding stimulus, but in terms of the tax rules and opportunities for realtors beyond that, there haven't been any major changes since 2018. So a lot of this may seem familiar to you. The other thing I'll say is many of these recommendations, this isn't intended to be a one-size-fits-all. If you're a new realtor, some of the basics will work, and I think I talked here about how you're taxed. I try to make it one-size-fits-all in terms of what we cover, but not all recommendations will fit. Some of these are for more established realtors. But like I said, if you're new, there's still some opportunities and nuggets in here as well. If you like bad humor, you come to the right place, because I've got plenty of that as well. So I'm going to start here with the basics of how realtors are taxed. And of course, if you've been a realtor for 1 or 2 years or more, you're familiar with this. But some of you guys who are new, and if you haven't been a contractor before, you may not fully know how you're taxed. So the first one I cover is income tax, and everyone's like, well, no kidding. So, but I say that basically say I'm not going to spend any time on how you're taxed regarding that. Income taxes are calculated for you for the most part the same way they were if you were an employee or something else other than deductions you're allowed, which we'll cover later. The big one I talk about is self-employment tax, because that's a new one for someone like you who may be new to the business and hasn't been a contractor before. Self-employment tax basically means Social Security and Medicare taxes. So when you're an employee, you have held from your wages about 7.5% in Social Security and Medicare taxes. Your employer matches that. So around I use round numbers, around 15% of your money, around 15% of your salary, half funded by you, half by the employer, is going to Social Security and Medicare. When you're self-employed, you're considered the employee and the employer. So all of a sudden, you're responsible for that full 15%. And that's oftentimes a surprise for new clients we have that come into our contractors or realtors, is that everyone understands I'm going to have income tax up to 37% in the IRS, 5% in Mississippi. They don't necessarily expect 15% in self-employment tax. And kids don't help with that. Home mortgages don't help. Property taxes don't help. The only thing that helps with that is taking the deductions you're entitled to lower against the commissions you receive. And that's why we always stress sort of like, track your deduction. Make sure you're accounting for everything so that you're not costing yourself an additional 15% in tax. Last one I want to cover is tax on net earnings after, that's what I call it, after business deductions. So again, no charitable, no kids, things like that. Social Security, by the way, is capped. Of that 15% I mentioned, about 12.5% of that is Social Security. After you net it, after all expenses, around $150,000 for this year, it goes away. So you're always responsible for around 3% of Medicare tax, whether you earn $10,000 in commissions or $2 million in commissions. Okay. Any questions on what I've covered so far while we're getting our tech? Let's give Tommy a hand with that. So, COVID-related news. Now, there's not much anymore. In fact, when I was reviewing the slides last week, this was full of information 2 years ago, a little less full last year. I only have it up here to say basically any stimulus you may have received over the last few years is gone. Any special tax credits you may have received over the last few years that were specific to COVID are gone. But if I do have on here, some of our clients 3 years ago in 2020 were allowed to pull from their retirement accounts to help supplement income from being shut down or what have you. You had the ability to elect to spread that over 3 years as opposed to including it in your income the first year. Last year was the last year of that. So if you did take advantage of that for 2020, you'll have to account for part of your retirement income you may have pulled out 3 years ago last year. But really, that's about all there is anymore with COVID as of right now. There was a lot of talk last year in December that they might extend some of the tax opportunities. They did not. One thing I do want to say, though, and it doesn't apply for this year, you're looking at your taxes for last year. 2 years ago, they did make a change, the government, where normally you're allowed only around 50% of your deduction for meals. And meals for this case is meals that you take out, but it's not going to Kroger and making something. It was a restaurant incentive, is what it was. Well, they changed the rule 2 years ago where you could take 100% of your meals as a deduction. And that's a big win usually for you guys if you're taking clients out to lunch. If you're on the showings, and you're having clients. If you're doing an open house and you have it catered, you do an open house, you bring it in from Kroger, that doesn't count. You have it catered, it counts. So that was in place in 2021 and for last year. It's no longer in place for this year, but I'm always a year behind. I'm still thinking about 2022 at this point until we get through about October. In 2018, as I mentioned, there were a lot of tax law changes, and I hate to keep going back 5 years because it doesn't seem as relevant. But for some of you guys who've been realtors in here for more than 5 or 6 years, these are still relevant. The government lowered tax rates. They did two things, a lot of things for the benefit of realtors, but they lowered tax rates and then they expanded the tax bracket. So what that means is before you went to the next tax rate, you had to earn more income. By next tax rate, I mean the higher tax rate. So by the government lowering the tax rates and expanding the brackets, it put a lot of extra money in taxpayers' pockets. They did disallow entertainment. Now, I just talked about meals. It used to be pay 50% of meals and entertainment. Now it's only meals. You cannot deduct any entertainment. So if you take a client golfing, it's no longer deductible. The beer on the course might be, but the golfing itself is. If you have season tickets to a football team, that's no longer deductible if you share the tickets with a client. You go to a Grizzlies game, no longer deductible. But if the meals or the food you have there is. Cap on state taxes, including real estate taxes. So if you itemize your deductions, meaning if you deduct your home mortgage interest, property taxes, income taxes, charitable giving, the government put a $10,000 cap on those. Now what that means is that is a lot, but if you have property taxes, have paid car taxes ad valorem in Mississippi, and you have income taxes in Mississippi, you'll be surprised how quickly you'll spend that $10,000. So if you have $15,000 in taxes, the government, as under current rules, is only allowing you to deduct $10,000 of that. This here, though, this QBI, qualified business income deduction, is a biggie that is still in place, and it is really, really beneficial to any self-employed individual for the most part, including, of course, realtors. Basically, what the government said is we're going to, after you figure your income and expenses and come up with your net income, net taxable income, this is just from your real estate. We're going to let you exclude up to 20% of that income from income tax. Now, the full amount is still subject to self-employment tax at 15% I talked about, but up to 20% is not taxed for income tax purposes with the IRS. That's a huge benefit. So again, translating that to numbers, $100,000 in net income, you may not be paid federal income taxes on $20,000 of that. There are, of course, caveats, rules. It's a complicated calculation, and there's phasing. So if you earn over $170,000 and you're a single taxpayer, you start to lose that benefit. If you earn over $300,000 and you're married, you start to lose that benefit. But again, that is a tremendous opportunity. Well, I've had clients who were on the verge of losing that benefit. And I'm not someone that goes and recommends spending money on deductions unless you really need the deduction. Excuse me, unless you need like a car or something like that. We say go purchase a vehicle if you need it in the next year or two and get your income below that cap so that you can take advantage of that 20%. And they end up paying for a lot of their vehicles through some sort of tax planning device such as that. So what can we do? What can we do as realtors? I'm going to cover your what I call your inside deduction, meaning deductions that are in the course of everyday business. And again, some of this may be basic for you guys, and I apologize, but we're trying to help as well anyone who's new to the business. The obvious deductions: advertising, brokerage fees, cell phones, office supplies, your E&O insurance, even if that's paid, by your broker. Sometimes your broker will charge you back for that in your 1099. That's deductible. Client gifts within reason, office rent, continuing education. You can read your travel. I put business portion only because I love realtors, but realtors are great about telling me, I own one rental property, and we went down to Destin to look at possible rental. Okay, I'm not saying they're not telling me the truth. But I'm not sure they could go look at possible rental property in Destin if there wasn't a beach there. And I don't know that they needed to take their 3 kids, their husband, with them. So while we will let some of that go, it's for the business portion only, meaning the number of days that they're actually working, some of the travel, some of the meals for you, things like that. So, but an example is if you go to a seminar in Destin, or Las Vegas or wherever. Well, more of that's business related. Or if you go to some continuing ed in an exotic location. We're not in our office going to tell you can go deduct your family going there, but you can justify more of your trip because more of it's business related. Accounting fees, fully deductible. So if you pay your CPA, you get to deduct all of it. Just want to reiterate that. So, what about these things? Meals we covered. So meals and entertainment. So unless there's a question, I'm not going to really spend any time on those. Home office, we get that question a lot. Yes, you can deduct a portion of your home as a home office. I will say this now. 2 questions I get is, can we deduct home office, and is it a red flag? We have never had a client questioned or audited on a home office. But I also tell every one of our clients, it's not that big of a deduction. That doesn't mean you shouldn't take advantage of it. But it's not going to save you the most we ever typically see is $1,000 to $1,500 in a deduction, which may only translate to about $700 or $800 in tax savings. It's not a home run deduction. So while we encourage every deduction we can get, there's usually more enthusiasm for it than value received, is what we see. Paying for repairs, expenses to facilitate a closing. I know that's been more and more common the last 10 years or so, and that is we consider that fully deductible. So that's, and then of course, if I didn't mention it, accounting fees are deductible. So, what about vehicles? Yes, ma'am.
When you say client use within reason, what?
General rule with the IRS is around $50 to $75 or less. It used to be about 25. They've upped that. I don't consider closing repairs obviously as a gift. That's facilitated transaction. But $500 to $600 gift, which don't see that very often, that would be considered extravagant certainly. We don't audit that. I don't know many CPAs that spend a lot of time trying to audit the client gifts, but it's good for you to have in mind $50 to $75 and consider it a reasonable gift. Vehicles are 3 ways that you can take advantage of a vehicle: or lease, depreciation, and mileage. I'll cover all of these. I'm going to cover the easiest one first. A lease, the business portion of the lease can be deducted. Of the 3, we see less tax value in the lease with our clients than we do the other 2. The 2 we see the most value with is mileage. Now, like I said, even as a failed realtor, I managed to drive around and be busy doing, not earning any money, obviously. But I know you've got an office with your broker. You may have an office at the house. That office has 4 wheels and steering wheel. That's where you guys spend your time. And so you drive a tremendous amount. And that's where we come in and say, please track your mileage. Keep track of it, because you will get, for last year, there were 2 different mileage rates. The first half of the year was 58.5 cents. The IRS, everyone remembers what gas was like last summer. The second half of the year was 62.5 cents. So you're going to get different mileage rates. It's one thing you'll have to do on your taxes for last year as you're filing is how much miles did you have the first half? How many miles did you have the second half?
Where was the half at?
It was right at July 1st. They made it an even break. So this year in 2023, yes, ma'am.
How can we track your miles?
How do you track your miles? I'm sorry, I need to repeat it. How do you track track your miles? So what we suggest, we have some people who do a log, we have some people who just estimate it, which isn't tracking. We suggest there are different apps on the phone that are tied to GPS.
That's only work related, right?
That is correct, only work related. So you're going and doing showings, you go and pick the child up from school, the school trip doesn't count. But the app on your phone, we find to be very common, easy to use, and it will generate reports for you at the year end. And it would be too late now, but it would have been valuable last year because it would show you your first half and second half of your mileage. 2023, they have increased the mileage rate to 65.5 cents. So for perspective, for last year, you drove 10,000 miles with work. You'll get around on average about a $6,000 tax deduction for that 10,000 miles. That's a lot of tax savings. I mean, so it's supplementary tax. You're starting to look at $2,500 to $3,000 potentially in tax savings county Mississippi. Even more this year. So track your mileage because it's one of the biggest deductions you'll have as a realtor. I have depreciation up here because another well-known opportunity is to go buy a large truck or SUV and write off a substantial portion of it as you purchase it. It's a great opportunity. We in my office don't promote going and buying vehicles unless you need a vehicle because you're all losing cash or taking on debt. But if you need a vehicle, you know, I can tell you an SUV like an Expedition, an Explorer, a Yukon, an F-150 truck, those tend to be more valuable to our clients than an Audi sedan or something like that. And it's because the heavier the vehicle, well, once you reach a certain point of around 6,000 pounds, and that doesn't mean the actual weight of the vehicle, that means capacity. So it may be 5,500 pounds, but it can hold with people and storage another 500 to get to that 6,000 pound mark with that. You can write off last year up to 100% of the cost of that vehicle. So I haven't seen even, yes, ma'am. Yes, ma'am.
Yeah, I was gonna ask you a question. So at the end of December, I had my business buy a vehicle because I knew that the tax rules, I understood they were changing, so December bought a vehicle. And, but I still had tracked my miles for the first, 11 and a half months, so I could still do a personal deduction for my mileage and then the business part of it.
Yes, because these rules are determined by vehicle. So what Jamie, to repeat the question for those online, what was asked is I had a vehicle that I was taking mileage on, I believe he said, for the first 11 months of the year, and I bought a new vehicle in month 12. It's by vehicles. So in other words, if you're using mileage, you can take your mileage deduction for the first 11 months. And then in December, if you bought a vehicle, you can deduct up to 100% depending on the vehicle type. You can deduct up to 100% of that last year as well. You can double dip. How many is your question?
Yeah, one of the questions in chat, they just asked if you could repeat if you mentioned a mileage app.
I didn't mention one specifically. To be honest, I don't know one off the top of my head. If you Google it, there's usually 3 or 4 that pop up. Yes,
I like you.
My like you.
That's what someone put in the chat as well.
That's one I've seen a lot of. Yes, ma'am.
What is it?
Electric vehicles, let me get to that in just a second. So, yes, sir.
How often can you do the deduction?
Yeah, so let me go back to depreciation here. So when you buy a vehicle to depreciate it, you're no longer eligible for that vehicle for actual cost, or excuse me, for mileage. You only can take actual cost. So in other words, you can't write off the cost of the vehicle and then take mileage in future use. You can still deduct gas, insurance, maintenance on that vehicle. It's not as valuable as the mileage. But the mileage doesn't give you an opportunity for I had a hell of a year, I'm going to write off as much as I can to lower my taxes for that year opportunity. So the write-off, to answer your question, could be done every year, but we don't suggest that. I'm about to tell you why. This term called recapture. So the IRS give it, the IRS take it away. They give you a write-off when you buy the vehicle. But if you go and sell the vehicle or trade it in, you got to reclaim what you wrote off. So if you're flipping a vehicle, we have clients who would like to buy a vehicle every 2 years or so. We do not suggest that strategy for them. Because they're claiming, they may buy one for 50, they're gonna have to claim 35 in income in 2 years. I'm obviously making up numbers, but now, the new vehicle they replace it with, they get to deduct as well. But you lose value. So we recommend this strategy for our clients who tend to hold vehicles for 3, 4, 5, at minimum 3 years, 4 or 5 years or so, unless they just put so much mileage on it, they just can't do that. And there are instances of that. Because again, the longer you hold a vehicle, the less valuable it is, the less you get hurt on the trade-in. But you could do it every year. It's not, you wouldn't do it with our office. We would talk you out of it because it's not much value there. I do have a note here. Jamie touched on this a little bit. Bonus depreciation change for 2023. Now, when I said you could write off 100% of a vehicle last year, that's not true this year. The IRS, I shouldn't say the IRS, Congress had put in special rules allowing you to write off 100% of a vehicle. Those rules expired. And so now on average, you can still write off up to about 75% the first year. Still tremendously valuable. The other 25% would be written off over the next 4 years or however long you own the vehicle, if you only own it 3 or what have you. But still a great opportunity in 2023. But again, that's if you need a vehicle. Or if you had such a great year that you're needing to offset taxes and you don't expect it to hold, which in this market, who knows? Tommy, there was a question you had, I think.
Yeah, we got a few. One, you said you were going to mention electric vehicles later on.
Yes.
The next one says, how can we find out the deduction amount of other vehicles?
That
Not
are not, again, I'm assuming they mean that aren't heavy. It varies by cost, basically, but I'm going to say in general, you can get close to 50% as a general rule on vehicles that are not as heavy.
gotcha.
Let me clarify too, when I say new, I mean new to you. It can be a new vehicle, and you still take advantage of these opportunities. It just has to be new to you. You can't buy a vehicle from your husband. And trust me, you laugh, we've seen it. These are real life examples.
And another person's asked and said, can you talk about the difference, if there is any, between buying a car strictly for business versus using it for personal use, or using your personal vehicle for business? I've heard for some reason not to buy a vehicle strictly for business as a realtor.
There's not much difference. In theory, you're only supposed to deduct a portion that's business use. So if you buy a new vehicle, you think you're going to use it 75% for business. Let me repeat that question, I guess, because they didn't hear that. I don't think.
Oh, they heard it.
Oh, they heard it.
And they wrote in the chat.
Okay. So you buy a vehicle, 75% of its business use, you're supposed to deduct about 75% of its cost. 25% is not deductible. So that's the way most of our clients will kind of handle that, is because very few business 100% business use. That doesn't mean we're not told they're 100% business use, but that in point of fact, if you have kids, you're going to pick them up in carpool. So we encourage our clients to use an estimate of what the business use percentage would be, and that's what we essentially write off. I'll give you just a second. I want to answer the electric vehicles question. So same type of rules apply, but electric vehicles aren't typically as heavy as 6,000 pounds. But electric vehicles have special tax write-offs that they just recently, it's one of the few modifications they got through. Long story short, you can get up to a $6,500 tax credit. Now, that's not a deduction. That's more valuable than a deduction. That means you can lower your taxes by $6,500 if you purchase an electric vehicle that meets certain rules. They've made those rules more strict, like batteries. They've always had a rule where final manufacturer had to be in the U.S. Batteries, I believe, now have to be made in the U.S. Or if not the batteries, the minerals and elements of the battery have to be sourced to the U.S. So I just say, car dealerships know these rules better than I do, to be honest, because that's their job. They're trying to sell them, they're trying to tell you it's qualified. There are also rules about the manufacturer can sell a certain number of vehicles and that tax credit was no longer available. I believe that rule was expired. It didn't expire. They eliminated that caveat last year. But you can go buy an electric vehicle. It won't necessarily qualify for the full first year write-off, but instead you could get a $6,500 tax credit for its purchase. And that holds whether it's business or not, business or personal. So, ma'am, you had a question?
Yeah. You said that you can deduct even the 75% or 100% of the vehicle that's new to you. However, is that true if the financing the vehicle?
Okay, good question. Let me repeat that. So the question was, can you still take these deductions if you finance a vehicle? The answer is yes. The IRS considers their loan to be the same as if you pull money out and bought it because you're obligated for the loan. It's a good question. By the way, other thing, you don't have to do the full write-off. There are options. It's not all or nothing. You can do you would need to talk to your tax preparer about your options for deducting the vehicle. Very few of our clients pass up the first year write-off opportunity, but that's not mandatory. Particularly like in the example I said, if I have a client who's flipping vehicles every 2 years, we don't do that usually. We come.
Into the lease, how much of the lease?
Lease is basically business use percentage. So if you have I'm gonna make math easy for me, a $200 lease and it's 75% use for business use, I think that's $150 that you can write off. So you're writing off essentially each payment made that year. But so there's value there, don't get me wrong, but it's not like you get the full value of the vehicle as a write-off that year. And we find that mileage typically will exceed a lease. And I'll say this, mileage often will exceed the full write-off period. But the difference is you can't take mileage year one. So we have many clients who will buy a vehicle and want to hold the mileage because they'll hold the vehicle 4 or 5 years. And over time, that mileage will often exceed the cost depreciation of the vehicle. But like I said, it's hard to pass up that opportunity. We typically will run a scenario both ways so clients know what the impact is.
They said, did he say we cannot write off the vehicle and claim mileage?
That's correct. You cannot take depreciation, meaning you can't write off the vehicle and take mileage. It's one or the other, and it holds for the life of that vehicle. So in other words, you can't alternate years. You buy it, you write it off, you're taking gas and insurance from that point forward. Yes, ma'am.
Alternate vehicles. Going through land, ATVs, 4-wheelers.
Yes, those business portion of those can be written off as well. Those are really considered more equipment. So you don't have weight limitations on an ATV or a mule or something like that. But I do, we always do say, be careful that our business use is important because we often find that there will be a ATV that happens to go deer hunting a lot. So, and I'm sure that's just an accident and they overlook the other deer hunting ATV in the garage. But we do say be careful on that. I'm going to move on because I only have about 25 minutes and still some other content. All right, a few jokes that I promised. All right. I hate laughing on jokes. They're all terrible. I guess. So my wife, if she can't sleep, what does she do? She asks me, honey, how was your day? Tell me about your day. So have you heard the interesting story about the accountant?
No.
Neither have I. All right, tax planning. I do want to get into this, and because of time, I'm going to go through this. Because now this is where at the beginning, I said, most everything I just talked about is one size fits all. It applies if it's your first year in real estate or your 50th year in real estate. By the way, if anybody's been here 50 years in real estate, you deserve a congressional medal of honor, especially after the last few years. S corporation. So we have realtors. You start out usually as a self-employed individual, a sole proprietor. After you've been in a while, if you're going to stay with it. And I say that because it's a hard industry. There's a lot of churn and burn. But if you like it, if you're successful, if you see that coming, if you're going to weather the market trends, because let me tell you something, no matter how good you are, there are cycles to this industry. Then we will often talk to our clients about establishing an LLC that their broker pays and converting that LLC to an S corporation. You don't change its legal identity. You're just telling the IRS, I want this tax as an S corporation. The biggest advantage of doing so is that you can eliminate a lot of that self-employment tax that I talked about. So you can minimize that 15% Social Security and Medicare tax exposure that you have. We always say, though, that with caution, if you do this, believe it or not, the IRS is aware of this strategy. So what they want to see is, like in your case, a realtor who set up an LLC, it's taxed as an S corp. They want to see you on payroll. So they want to see you as an owner of an LLC as well as an employee. That payroll is subject to Social Security and Medicare. So the amount you pay yourself on payroll is not sheltered from this tax savings opportunity. But we don't recommend this strategy without recommending you sign yourself up for payroll, because it just creates too much exposure. It's too easy for the IRS to see this and catch on to it and charge you as if you were on payroll, essentially eliminating this tax benefit. Advantages: minimize self-employment tax, does open up some opportunities for group retirement and health insurance. However, sometimes the retirement opportunities in this are not as good as if you say this is sole proprietor. We'll talk about that as well. Disadvantages, payroll compliance. So I mentioned payroll. Once you're on payroll, all of a sudden you got, if you're a Mississippi resident, Mississippi withholding that's paid monthly and a tax form that's filed monthly. Mississippi unemployment that's paid quarterly and a tax form is filed quarterly. IRS taxes that are paid probably monthly. IRS tax filings that are filed quarterly and annually. W-2. It is a lot of work. And so that's why if you're just new into this, we will never recommend this because the benefit, the cost, the compliance, but you got to pay someone to do that. That compliance, or you use QuickBooks to try to manage it yourself, but the compliance overrides the benefits. We also don't recommend this, frankly, just as a general rule, unless your earnings are flirting with your net earnings, not gross commissions, but net earnings, flirting with around $100,000 or so on a relatively even basis. What I mean by even, it's predictable every year. And it's because, again, the compliance can outweigh the benefits of it. But if you're a realtor and you already have an assistant who's on payroll, it's a natural strategy for you because you already have payroll in place. So it's something to consider. I mentioned limited retirement opportunities, interaction with QBI deduction. That QBI deduction is a 20% rule I mentioned. You change this, it's not quite as easy to qualify for the full 20% write-off as it is if you're a self-employed individual. And I have here the tax address, meaning what's the savings opportunity? It's in that 15% self-employment tax. You pay the same income tax whether you are an S Corp or not. The S Corp does not save you any federal income tax. It doesn't pay income tax. All the income comes to your personal return, but there's no federal income tax savings. It's the Social Security and Medicare that you end up saving.
Hey, James,
Yes, ma'am.
talking about LLC to the S corp. So what about just being an LLC?
The LLC, your tax is essentially the same way as you are a sole proprietor. Now, the reason I recommend an LLC, and I'm not an attorney, so let me say that here, especially for any attorneys listening. So I'm not an attorney, but it's easy in Mississippi. It's $50 to set up an LLC in Mississippi. I mean, and then you have to renew it each year. Guess what the cost of that is? $0. Mississippi is a very business-friendly state. I will say that. I want to say that because we have clients in Tennessee. By the way, if you live in Tennessee or most of your earnings are sourced in Tennessee, you do not want to use that S Corp strategy. It's beyond the scope of this presentation going into why. But we have to, in this area, be mindful of where your earnings are in which state. Arkansas, it works. Tennessee, it doesn't. Mississippi, it works. That's your question. Okay. Retirement accounts. So, our office is big on recommending deductions that don't cost you money, but that may help grow your savings, your wealth. That doesn't mean we don't say go buy a vehicle if you need a vehicle, but we don't say go buy a vehicle if you don't need a vehicle because you lose the cash, use some of the debt. The tax savings doesn't necessarily justify the cost. We love retirement accounts. We do not sell this in our office. Very few CPAs do. So it's not like I'm trying to push kickbacks. I just like knowing that my clients are saving for their future. Advantages, tax deduction that pays you. What I mean is, give me just a second. You get to write off the retirement contribution, but it's not going to Ford. It's not going to Tesla. It's going to you. You can't take it right away. I think I talked about that, the disadvantage. Can be made after year end and still apply to the year. So every year in June, I get a client that says, what can I do for my taxes? And unless you got a time machine or a DeLorean like Michael J. Fox had, you're mostly out of luck. Many retirement plans will allow you to make a contribution, some as late as October 15th, and take it on the prior year. That's a tremendous hindsight deduction opportunity that doesn't apply. You go buy a car now, you can't take it last year. You make a retirement contribution to the right plan, you can take that as a deduction for last year. It can lower income for the QBI deduction. That's what we've touched on already. Okay. Disadvantages, not all plans work with the S Corp structure I talked about, and that's where it's hard with these. We do a cost benefit analysis, and most CPAs or tax offices will, because if all of these work, I tell you do them all. But one helps the other, one hurts the other. I mean, it's a give and take. You can't touch retirement funds as a general rule until you're at about age 60. So you're saving for retirement, you're paying yourself, but it's your future self. If you're young like I am, 47, I'm not that young, I'm joking again, but I can put money into retirement, but I'm not going to really be able to, I shouldn't touch it for 13 years. If I need it, I can, but I'm going to pay a 10% tax penalty in most cases on an early distribution. 2023 note. If you are participating in retirement plans, whether that's with an employer, your husband's or wives doing it with an employer, you have a SEP plan. All of our retirement plans this year took a large jump in terms of how much you can contribute for inflation. The largest I've seen since I've been practicing. An example of that is a 401k. Under 2022 rules, you can contribute up to $20,500. 2023 is now $22,500. That $2,000 jump is the largest I've ever seen. So there is more opportunity than ever for these plans because of the inflation jump. Maybe you had a question, I think.
Does each source of income have to have an S corp? Let's say if you you already have a business and you're an S corp, do I have to do another S corp in order to do my real estate, or would it be like the same S corp?
Okay, that's a good question. You don't have to, but we oftentimes will suggest you separate certain activities. I mean, if you have a construction company or a real estate that you rent real estate and you use an S corp for that, I'm just making up an example. That's a natural fit for the real estate commissions to go into. But if you, and I'll also say, you usually don't want to mix income streams by person. So if you have a spouse and you both own the S corp, you don't necessarily want to send your commissions to the S corp because now he or she is being taxed on it as well. Now, you're still on your return, but we like to keep taxpayer income streams segregated by taxpayer in the case of real estate commissions. Rental property, construction, so people owns different. But I wouldn't mix businesses too much. So in other words, you sell cars, I wouldn't put and you've got S corp with it, I wouldn't put real estate with that. Liability purposes as much as anything. You have an S corp that you co-own with somebody. If they're not in real estate, it may not be to their advantage to have that income coming to them as well. Any questions on retirement savings? Nope. Yes, sir.
What if you're a midget over 60,
Mhm.
still building,
You can still contribute. Yes, ma'am. Yes, ma'am. I'm sure you're not asking for yourself. You're too young. But if you're over 60, you can still contribute. Absolutely. Tommy, that's news for you. He's over 60. Yes, there's nothing to preclude you from contributing, at whatever age that is.
You can contribute, but when you take it out at any time.
You can take it out at that point as well. Now, I will say, if you're contributing, it's taxable when it comes out. I'm glad you asked this because I should have had this up here. When you pull that money out of a retirement plan, it's taxable. So if you contribute now and you pull the same amount out, it's a wash. You're not benefiting. You know, the goal would be to set it in there and let it build. I'm not going to go into requirement on distribution. That's beyond this. But anyway, that's a good question. I'm glad you brought that up. All right, realtor humor. So I make fun of me, I'm gonna make fun of you guys. So what's a guaranteed way to make $1 million in real estate? Spend $2 million. That's the old punchline. The new one is buy a rental house and sell it to a hedge fund, it seems like. All right, you have a gun with 2 bullets, and you've got an appraiser and a realtor and a lawyer. What do? 2 bullets, 3 people, an appraiser, realtor, and a lawyer. You shoot that lawyer twice. More tax planning. Again, these aren't one size fits all. By the way, I told you, I warned you there would be bad jokes. None of you left. It's your own fault. Children on payroll. So this is becoming more and more common. We get a lot of questions on this. It can be a very good strategy. Advantage is shifting into the lower tax bracket. You can pay your kids up to $12,000, $13,000 and they don't pay any tax on it. That's not as easy as it sounds. I'm going to go over, there are substantial disadvantages in possibility of avoiding self-employment tax. What I mean by that is if you're a sole proprietor, so again, this is an example where the S corp doesn't work as well as you're a sole proprietor. You have a child on payroll who's 16 years or under. You put them on payroll, they don't have to pay Social Security, Medicare, and you don't have to match it. So not only are you saving income tax, you're saving that 15% self-employment tax for you and for them. Kids can't set up retirement accounts. We'll see this where we have clients who will have kids on payroll and they'll put the money into a retirement account. They may pay private tuition with it. It could go to college. The kids, it's in theory their money with you overseeing it, but they have some of the same opportunities you have.
James,
Yes, ma'am.
so this kids on payroll thing, is this more for self-employed and would they be 1099?
It's more for self-employment. In other words, it doesn't work real well as well. It can work with S corps too, but you don't say it's self-employment tax. And this is not 1099. This would actually be a W-2. Because if you 1099 your child, they're all of a sudden having to pay in that Social Security and Medicare. Other disadvantages, IRS scrutiny of children aren't reasonably paid. Yes, you can pay your 3-year-old $12,000, $13,000. But I sure wouldn't want to answer the question as to what they did to deserve that tax. Common things we see for realtors is they show up in marketing flyers, they're in ads, what have you. The older the child, in my opinion, the easier it is to pay them more. And we have clients who we suggest they stagger payroll to their kids based on age a little bit. I've got 15-year-old who helps clean the office, helps me decorate for Christmas. I've got an 18-year-old, I don't pay him anymore because he'd have to pay the Social Security and Medicare tax, but my 15-year-old still qualifies. I pay him a reasonable rate for that each year. Additional compliance costs for payroll. So again, if you don't have anyone on payroll and you set your kids up, all those tax deposits and tax filings I talked about still apply to the kids. This strategy works best if you are looking to put yourself on payroll through an S corp, or if you're a sole proprietor and you have like an assistant on payroll. Then it's just a matter of signing kids in there too. But I am going to reiterate, be careful how much you pay them. Make sure it's documented what they do. Make sure you're paying them a reasonable rate for that. You don't want your child necessarily growing up wanting to dig holes in the ground because he's getting $30, $50 an hour for it. He thinks that's what everyone gets for that. You know, you want it to be a reasonable rate and justify what they do. Tommy?
Someone asked, what platform can they set up retirement accounts?
They would, I'm not a financial advisor, but I mean, it's common to see you can set up something through Vanguard or you can contact a financial advisor. I think Amanda said there's going to be one here. And another speaker series, drill that person, make them answer those questions. There's a lot of different retirement plans that I'd love to go into for realtors. Make sure they answer those questions.
And the same person asked, does payroll need to be some consistent pay schedule, like bi-weekly, et cetera, or can it be per job?
Yeah, that's a good question. I think it could be both if there's per job. But it certainly, I have my child on a consistent payroll schedule. So. Was there another question? I thought I saw another hand up. Nope. Okay, good. So the taxes addressed in this tax planning idea is Social Security, Medicare tax, and self-employment tax, and income taxes. But again, this can conflict some with the S corp strategy. So you have to model and see what's best for you. Tax planning idea, another one, rental real estate. I don't know who in here, how many owns rental property. You don't certainly have to raise your hand. Rental property, I'm a big believer in. Whether you're a realtor or not, it's a great investment. It may not be quite as attractive as it was 2 or 3 years ago for interest rate reasons and property appreciation. Hard to find good price properties in DeSoto County anymore. But advantages, special tax treatment for realtors. Well, what I mean by that is sometimes real estate rental property will generate a loss. You have a property, you have turnover, someone leaves, they destroy the property, it generates a loss. Well, if you're not a realtor, or you're not a real estate practitioner of some sort, and that property, let's say it's your whole portfolio, 1 property, 10 properties, whatever it is, if it has a loss for that year, and you earn over $150,000, you cannot deduct that loss that year. A realtor does not have that limitation. They are considered to be in the business of real estate. So if you have a loss, you can take it against your real estate commission income. Not every taxpayer can take advantage of that. Depreciation benefits. So we talk about depreciation of cars. You go and buy a house, the IRS will give you 27.5 years to write off the value, the cost of that house. So if you buy a $100,000 house, that's going to approximate to be about a $3,000 tax write-off. Well, we all know the house isn't depreciating in value. But the IRS considers it a business asset and they will let you write off that $3,000 every year you own that property. There are some downsides. You go and sell that house, you have to reclaim some of that, well, probably all of that depreciation write-off you did, just like you do on a car. But most of our real estate clients hold rental property. They're not looking, well, that was up until the hedge fund era, but that's coming to, at least it's dying down. But most of our real estate clients historically have held rental property. They're not looking to sell it. Disadvantages, hey, you may have a property right now, rental rates are the highest they've ever been, occupancy is the highest it's ever been. The bad side is you may have rental property income. It may not produce a tax benefit. But I ask the question, is that bad? You know, I will stand here and tell you, yes, you may owe more tax, but it is never bad to have something that you make money on. just know you're gonna owe some tax on it. I'd much rather pay the government $2,000 in taxes on a rental property than have a loss and shell out $7,000 or $8,000 from a tenant who tore up the house. So taxes are not always bad. Just know that the rental property and the losses, usually those come about, it's more and more rare in this rental market, but they come about more from tenant turnover, properties that are vacant, things like that. Related to rental property, we are seeing, you guys probably have heard some of this cost segregation studies. Is that term ringing a bell with anyone? These are becoming more and more popular. So if you recall, I mentioned depreciation. You buy a house, the IRS will give you 27.5 years to write that house off through depreciation. You buy a commercial building, the IRS will give you 39 years to write off the cost of it. It's a slow recovery. These cost segregation studies, they basically have engineers that will look at the house and break it into components. And some of those components could be eligible for a first year write-off. Some of them won't be. They'll still be over 27.5 years, but it's not uncommon for us to see 30% of the cost of a house be eligible for potentially up to that first year write-off. Now, please understand with this, you're not writing off more than you would be allowed if you held the house 27.5 years, but you're writing it off fast. And because you guys are realtors, where someone who's not a realtor, this cost segregation study may not make sense because their income limits their ability to write it off right away. You guys don't have that limitation. The cost segregation studies, which we don't perform, again, I'm not pushing a service here. They are good opportunities, better opportunities for realtors and real estate investors who are real estate practitioners than for most other clients we have. But they're expensive too. That's the other thing. When we have a client who's considering it, we'll look at the savings versus the cost to determine whether or not it makes sense or not. If you have rental property and you have put it in an LLC, you can transfer the LLC, some of that LLC ownership to the kids. You can set up an LLC, give them ownership before there's anything in there, and then put property in there. And the kids don't pay any tax or anything. So the same rules about payroll and up to $13,000 before it's taxable. Some of that still applies as well. If you have an LLC that owns rental property, you can give the kids 5-10%. You're removing 10% of that, or 3 kids, 30% of the income from your tax return and shifting it to someone with a lower tax bracket. We don't think this is a bad idea. I will say, younger kids may make more sense because you may not like who that kid marries. And then all of a sudden you're in business with a son or daughter-in-law that you do not like. And I hate to be morbid, but I've seen it. Your child dies and then you got somebody you just want to get out of that business. And so younger kids, you get more advantages with it. You got a 20-year-old, full disclosure, I got a 15, 18-year-old. They're not getting anything right now. I'm trying to see if they marry. So. But I'm the devil. So Section 1031, this applies to all real estate investors. Section 1031, you guys probably heard of, it's called the like-kind exchange rule. You can sell a rental property and buy a replacement one. It can be in a different area, different state. It can be more, it needs to be probably more expensive for it to work correctly, but you don't pay tax on that sale. Rather, that tax is deferred into the new property. That doesn't mean you won't be taxed on it down the road when you sell the new property unless you do a like-kind exchange, but it does offer you a deferral. So a great example would be, I've got 3 rental houses in a hedge fund, because I've seen this a lot. Hedge fund wants to buy. I don't want out of real estate. Instead, I'd rather go put the money into a commercial building. You sell the 3 houses, you do the like-kind exchange, and you don't pay tax on that sale. You roll those gains into the purchase of the commercial building or to a vacation property that's going to be rented, something like that. There are a lot of technicalities around that rule that is beyond the scope of what I can talk about today, so be careful. I mean, there are a lot of, don't do this on your own. Get an attorney who knows how to do these. You go down this road. Yes, ma'am.
That rentals were also like business as well.
It's only, good question. It's only real estate, and it's not your personal plan. Which there's gain exclusions there as well. But so you can't do it with cars, you can't do it with a business. Now, if you have an LLC that owns rental property, it can qualify through a different couple of different strategies. But if it's an LLC that owns construction business, it won't qualify. Also, flips are not eligible. I got this question yesterday. You can't do this strategy with flips. If you flip property, you're going to pay taxes on it. All right, we're running short on time here. To-dos, record keeping. I know that sounds basic, but I'm convinced more of our clients lose tax, pay more taxes, not through strategies, because I don't keep track of their record. I love all our realtor clients. They are not bookkeepers. They are not record keepers. And so, I would just encourage you to come up with some sort of system where you're tracking your expenses, because you would be amazed how much you're missing if you're not organized with your records and your expenses. Think cash flow. This comes back to some of what I've been saying. Don't go buy a car unless you need a car. Our office emphasizes cash flow. What I mean is, don't go spend $50,000 to save 15 if you don't need it. Because that's what you're talking about. You go buy a $50,000 vehicle, you may save 15 to 20,000 in taxes, which is great. But you're out the cash, or you're on the hook for a note. So don't do it if you don't need it. We tell our clients, look, if you don't need a vehicle, don't buy it. Pay 15,000 in taxes instead, and keep the rest, the other 35. So that's why I say cash flow, and that can be evaluated, but that should be looked at over 2 or 3 year period. Meaning, if you're gonna need a vehicle in 18 months, that's something you should consider looking at this year. January is too late. That's back to that question we did, what can I do for my taxes? Other than retirement plans, last year is last year. You know, you can't go buy a vehicle now and go get credit for it. You can't put your kids on payroll, and you probably could slide it through with the right situation in January, but not in February. So again, have conversations with your tax preparer during the year. Do tax planning. It doesn't have to be every month. It doesn't need to be. You'll never get me every month. I'm going to tell you that. We're just slammed right now. Most CPAs are. But make a point to have at least an annual conversation before October or November with your tax preparer. But you've got to be organized. I can tell you with us, you're coming to us wanting tax estimates and you don't have your records, we can't make it up. We're only as good as the information we're given, and that's true for any tax preparer out there. Estimated payments. You're not saving taxes here, you're saving penalties and interest, which can add up. And interest rates are higher now than they've been in decades. That means interest on unpaid taxes or delinquent paid taxes is going to be higher than it's ever been. 4 quarterly estimates are required. I shouldn't say required. They're requested by the IRS each year. If you don't make them, you're going to pay interest and penalties. So just especially for my new realtors in here, keep that in mind. That's basically the end of it. I'll answer any questions and close with 2 terrible jokes, and then I'm going to get back to work, and I know you guys need to. Yes, sir.
Basically for private money or money on specific property, and can we to give for people that we can
It's a good idea to do so. Yes, if you really should, from a compliance perspective, file a 1099 INT with them. Yes, sir.
What is the most reasonably expense for safety? Being a firearm, ammo, training to save the year.
I don't think there's a hard and fast rule for that. Again, the ball's always going to be business use. And so, I know I wouldn't hesitate to look at for a realtor who's really working full time to look at 50 to 75% or something like that, maybe even higher. For the training, things like that. For firearms, you know, again, if you deduct a gun and you sell it, you got to claim whatever you get on it. But I'd say 50 to 75% is usually a good rule of thumb for most of these deductions that aren't 100% business use. So, Tommy.
We got a few online real quick. Going back to the first mileage slide, it was it said that it cannot be claimed your first year as an agent? Was that ever said?
No,
Okay.
I don't. If it was an accident.
Okay, so that's wasn't said. And then another question, if someone is over 65 on Medicare, but self-employed part-time, can they deduct the cost of the premiums for supplemental insurance and prescription insurance for their Medicare coverage?
If they're not part of an employer-based plan, you can deduct Medicare supplements and self-employed health insurance expense.
Perfect. And this next one, I don't know if there's a summed up answer for it, but how does tax credit work?
Yeah, that one, I'm gonna have to say tune in next year on that. Okay, because that's pretty broad. I don't know which credit. You know what they may be asking, that's related to the electric vehicle. If that's what they're asking about, what it is if you save $6,500 in taxes and you have a $6,500 tax credit, you have 0 in taxes that you owe. Compare that to a deduction. If you have a $6,500 taxes and you have a $6,500 deduction, you're probably only lowering your taxes by about $2,000. So a tax credit is a dollar for dollar savings, whereas a tax deduction we estimate is around 35 cents on the dollar. That's probably what they mean.
I think that's what it is.
Yeah, that's a good question. So, yes, sir.
What are your health insurance? Anything like if you're doing like a Medi-Share plan or some kind of like the Clearwater, not gonna be just Clearwater, they have more share plans.
Yeah, so if you're part of an employer-based plan, then you can't deduct it as a self-employed individual. You can look at whether it will qualify on on your itemized deduction, but many times it can be pre-tax plans. If you're self-employed like I am, and you have a private plan, like I do, or in the question that you're on Medicare, you can deduct a portion of that as self-employed health insurance. But if you're on a government plan, or if you're on COBRA, because you left a job, you're not eligible to deduct that until you get on a plan that's specific to you and not to an employer.
If an agent has 0 sales as a first-year agent, but spent money on advertising and lead services, et cetera, are these still tax deductible?
They are, yeah. Yes, ma'am.
So just, on the, each commission check, do a percentage to kind of hold out. What's a good round number?
That's a good question, because commission checks grows before expenses. So it will vary based on what the actual tax is, but we're going to recommend usually 15% or so, because you haven't taken any expenses off that commission check. You haven't taken your mileage or anything like that. If you had a number that was after all your expenses, that's what we're going to be saying 30-40% with self-employment tax. But without having your expenses there, the more you earn, that rate would go up, but we're going to suggest usually 15% or 20%.
I've been putting out 30% each commission check.
Well, if you don't get a refund, don't come shoot me, but that's good.
I've got it, but
You should be well funded, so,
very good.
any other questions? Okay, guys, well, I appreciate it. This has been a really good group. You guys have smiled. I'm not surprised, but everyone knows, I'm not surprised actually. The H for realtor, the H that's in realtor stands for happy. So I hear 2 or 3 people. Last one, in our office, just so you know, I don't want anyone getting confused. When you hear us say IRS in our office, it stands for I'm really sexy. You have to be specific in Internal Revenue Service call. That's all I got, guys. Thank you for your time today.